Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors, Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. My name is Michael Hewson and joining me again is Pepperstone Senior Market Strategist, Michael Brown. Hello to you, Michael.
A very good, evening at the
It
time of
is.
recording
Yeah,
this, Mr. H. How are you doing?
I'm good. A bit tired, but yeah, pretty much ready for the Christmas break, I think, and looking ahead to New Year.
Yes, I
And I
think you
think,
speak for us all in saying that.
and I think on that note, what I'd like to draw your guys' attention to is the news and views section of the Good Money Guide website, because as with any year that comes to an end, I think the focus turns to the new year in 2025, and there's a number of really interesting articles on the Good Money Guide site. Best UK healthcare and pharmaceutical stocks for 2025. Quite an interesting piece by Ed Sheldon. Best Investment Trust for 2025, a piece by Darren Sinden. As I say, you can find that on the homepage. Top Fund Picks for 2025 by Darren Sinden again. Best Things to Invest and Trade for 2025 by Jackson Wong. What to expect from sterling in 2025 from me. Um,
The best
so
piece on there, of course.
well, I'm not sure about that. I'm in fairly salubrious company, shall we say. We've got some really good writers on the Good Money Guide, and they're certainly worth certainly worth listening to. Darren's done a really good piece on where could Nvidia be in 5 years, and certainly think that's worth a look. Given that when we did the quiz, the Good Money Guide quiz, and you can find that on the homepage, we talked about the challenges that Nvidia might face over the course of the next few years to the profit margins. And I think essentially, um, nearest competitors can eat into their market share. But before we get into the weeds of what we're going to talk about more broadly, we better get down to the disclaimer before you have to remind me again.
We should indeed.
Okay, so the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex financial instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So, we've talked about looking ahead to 2025, and we do have some podcasts between Christmas and after New Year where Michael and I both look at what to expect, looking back at 2024, the FTSE 100 best performers, worst performers, how well the pound could do or not do in 2025, what the risks are for that. Look out for that next week, around just after Boxing Day, I think. And then just after New Year, Michael and I look at the banks and the oil and gas sector with a little bit of retail thrown in. And I think the retail aspect is very, very important because of the week beginning the 6th of January, we get all the post-trading updates, the post-Christmas trading updates from all the big retailers like Next, Marks and Spencer's, Tesco's and Sainsbury's. And I think that could tee us up or give us a positive or an optimistic start or otherwise for 2025. So on that note, let's look back at what we previewed last week. And it's certainly been an interesting week for the UK economy, Michael, hasn't it? We've had CPI, wages and unemployment.
Yeah.
Tell me your take on those numbers.
Interesting is one way of putting it. I think pretty grim would be how I would phrase it, to be completely honest with you. And just to go through those figures, unemployment held steady at 4.3% in the 3 months to October, which is not too bad considering that the economy actually contracted by 0.1% on a month-on-month basis in both September and October. The real worry, though, is signs that price pressures and elevated price pressures are starting to become embedded within the UK economy. So, if you look at the earnings data, both regular pay and overall pay, when you include bonuses in the metric, those measures rose by 5.2% on an annual basis. For a bit of context, the BOE have a rule of thumb that basically says anything over about 2.5% is earnings growth that is incompatible with their 2% inflation target. So we're clearly some way above what the sort of earnings growth that the BOE would be looking for. And then obviously Wednesday morning we got the latest inflation figures, headline CPI rising to 2.6% in November on an annual basis, the core metric at 3.5%, and the services metric at 5%, which the latter two metrics were a little bit below where markets had been expecting them to be, but nonetheless were higher than the previous month. And clearly, at a headline level, we are still moving in the wrong direction. So I think actually this really cements the case for the BOE to stand pat on policy at their final meeting of the year on Thursday lunchtime, and just re-emphasises the idea that we're dealing with what is effectively stagflation here in the UK moving into 2025.
Yeah, and I think if we're talking about wage inflation, were the most recent public sector pay awards included in that number, or have they still got to filter in?
They're starting to filter into the data. We will see that impact the November print and potentially even the December print as well. The other thing to consider with the public sector pay rises is a lot of them were backdated. And if that, it's somewhat questionable as to whether the backdating will actually be included in the ONS data. But if it is, then that's certainly going to boost earnings growth even further. And when earnings are growing at 5.5% on an annual basis, the BOE's hawks, like Catherine Mann, have plenty to point to flag that risk of
Mm.
inflation persistence, which is looking very, very real and very, very serious.
Well, you said if they're adjusted, then ultimately the Bank of England has a bigger wage inflation problem than perhaps they think they do, and
Hmm.
that will then be reflected in the numbers when the ONS then adjusts them.
Yes. And of
So
course, we must remember amid all of this that the ONS have had to caveat these surveys very, very heavily indeed, because they are actually quite inaccurate due to a significant fall in survey response rates. So something like us saying, unemployment held steady at 4.3%, the real unemployment rate could be quite considerably higher than that.
mm, yeah. It was noticeable that when in the unemployment numbers, the vacancy rates actually dropped or the hiring rates dropped
Hmm.
quite substantially. And I think that's an early warning sign, perhaps, that businesses are now starting to become a lot more cautious when it
Yeah,
comes to
definitely.
taking on new staff. So that
Yeah,
is a little bit of not so much a red flag as maybe a mildly pink one.
or sort of amber
Yeah,
warning
yeah,
light, I
amber
suppose.
warning light. Yeah.
I think you're absolutely right, and I think this is the first impact of the national insurance changes that is starting to come through, because businesses will be sat there, and we are, of course, coming towards the end of the year, so a lot of businesses will have already done their sort of strategy planning for the year ahead, and they will be looking at their headcount plans and saying, the assumptions that we had made are now wrong. It is going to cost us a lot more to employ not only our current employees, but also to increase headcount and therefore revising their hiring plans as a result. So, as you say, I think that's a sort of concerning leading indicator, and you would expect actually the labour market to soften further as we move through, well, certainly the first half of next year.
Yeah, it's interesting because I was just before we came on air, I was just doing a little piece on food retail with a view to looking ahead to early next year.
Hmm.
And at the last trading update for Sainsbury's in the first half numbers, they estimated that the changes to tax and national insurance and the minimum wage would add £140 million to the 2025-2026 tax bill. Well, you know, if you want to maintain your margins, that's the last thing you want, to be paying another 140, 150 million pounds in more employee costs, which is essentially what that is.
Absolutely. And of course, the question then is, and this is where this becomes a bit of a sort of self-fulfilling cycle, is, Sainsbury's have an extra 140 million quid's worth of costs. Are they going to absorb all of that into their margins? I highly doubt it. What do they then do? They either lower the pay increases that they may have otherwise given, or they pass that cost on in the form of higher prices that you and I and all of our listeners will pay when they go to the tills to do their weekly shop, which, guess what, fuels inflation.
Or at least it keeps it higher for longer. And I think that's probably the key thing here, because
Hmm.
supermarket sector is very competitive. Not only have you got Tesco's and Sainsbury's, you've also got Aldi and Lidl, who are really eating the market share. Not so much as Sainsbury's, but the likes of Asda's and Morrison's. Aldi and
Mm.
Lidl now make a combined total of 18.7% of the UK grocery market. Now, I can remember back in the day when it was around about 10 or 12%. Sainsbury's is broadly unchanged at around about 15 or 16, and Tesco's is 27.9. These are
Mm.
Kantar numbers, which I was looking at before we came on air. So, you can see it's having an effect. Um, some of the loyalty brands that, Nectar, Tesco, Clubcard are helping shoppers save money, but there will be an effect. And it will essentially mean that inflation is likely to stay above target for longer. And that was something,
Absolutely.
that I think the Federal Reserve's Chairman Jay Powell talked about in his press conference earlier this evening. And that gives you a clue as to when we're recording this.
And that
Um,
also to our viewers, that gives you a clue as to why I look particularly haggard this evening, as to having had to just endure an hour or so of that.
yeah. Well, I watched it as well. So it was either that or watching Arsenal versus Crystal Palace. And I think that came in a distant second because Arsenal are losing 1-0 at the moment. Um, in any way, joking aside, sort of levity aside, we also saw the latest flash PMI numbers, and again, very disappointing out of Europe. Manufacturing very much in the doldrums, but manufacturing in the UK was also very weak as well.
Yeah, absolutely. I mean, the manufacturing index here in the UK, I think it was an 11-month low that we hit in the PMI figure, the flash PMI figure for December. Just getting that up on my screen here.
47.3.
Spot on. The Eurozone number even worse at 45 spot two. Yeah, at this point, you almost expect the manufacturing sector to be contracting on a monthly basis. What I would say, though, actually, and surprisingly, we did have a little bit of good news contained within those PMI figures, which is that on both sides of the channel, the services PMI that rose to 51.4. So the Eurozone index back into expansionary territory. The UK services sector expanding at a slightly faster clip in December than we saw in the month of November. So perhaps a small modicum of optimism there. But overall, of course, this is just one soft sentiment survey. It's sort of one swallow doesn't make a summer, so to speak. And particularly, you look at some of the other Eurozone metrics we've had this week. The IFO Business Climate Index, very well respected survey out of Germany, that fell to its lowest level since May of 2020. And I don't think I need to remind any of our listeners that May of 2020 was not exactly when the global economy was going gangbusters, so to speak. So certainly you wouldn't say that either economy is out of the woods just yet.
Yeah, we were all playing Netflix or basically doing other bits and bobs at home then, I think pretty much, in lockdown. So
Yes.
yeah, um, not a particularly good place 4.5 years ago now. Okay, so we've talked about that. So let's get on to the Fed, because I think that's probably what we really all want to talk about.
Mm.
And I warned last week that perhaps, we've had this toing and froing, you and me, about the fact that I don't really think that the Fed needs to cut rates. The economy doesn't really justify it. And certainly one person on the FOMC who happens to agree with me, because there was a dissenter, and the Federal Reserve did cut rates by 25 basis points. But I, in my note, I warned that perhaps their guidance for 2025 might not be as acceptable to, shall we say, the bond markets as we'd like to think that it was. And it turns out I was right, because bond yields have just shot up quite sharply,
Mm.
with the US 10-year jumping to pretty much close back to its levels that it was back in April.
Yeah, absolutely. I mean, as we record this, the 10-year is just nudging 4.5% to the upside. But forgive me for looking like I'm looking up to the sky. I'm looking at some
Mm,
charts up there.
mm,
But yeah, I think really the decision from the FOMC was an interesting one. It was probably about as hawkish a rate cut as they could muster up. Of course, they did deliver a 25 basis point rate cut. They effectively had to because money markets had discounted about a 95% chance that they would in advance of the meeting. And well, I was going to say that the Fed don't like to rock the boat, but we've got an S&P that's down by 2.5% and a pretty brutal sell-off across the Treasury curve. So it looks like they've failed in that objective. And I think what the market is really focused on is firstly the Fed's updated dot plot, which signals a median expectation that they will only deliver two further 25 basis point cuts next year, which would obviously be half the magnitude of the policy easing that was delivered over the course of 2024. And also Chair Powell's press conference, where he was really stressing how the Fed's reaction function is now much more two-sided, and that while there is still the option there for them to go more quickly on normalizing policy if the labour market were to weaken unexpectedly, he's also now explicitly put the option on the table that if inflation is not, and I quote him here, moving sustainably towards 2%, then they have the option to dial back restriction a little bit more slowly. And I think that's really what the market is focused on. The fact that the Fed have now opened the door to skipping a rate cut at the January meeting, perhaps even skipping a rate cut at the March meeting, depending on how intense those upside inflation risks in the early days of a Trump presidency prove to be. But ultimately, this is not a particular surprise. I think maybe the dot's a little bit more hawkish than we would have expected, but really we all knew coming into the meeting that Powell's objective would be to build in a bit more optionality around the Fed's policy tools going into next year and imply that the risks are much more two-sided. And that's exactly what he's done. So I think I wouldn't be too surprised when the dust settles if we see some of these relatively violent moves, which I stress are still taking place at the time of recording, just pare back and fade a little bit.
Yeah, we've seen euro dollar head back towards its lows of the year. It's now below 104, heading to 103.5. So maybe it does go to parity, and you end up losing that bet.
I hope not.
Um, um, but yeah, I mean, it goes back to that conversation I think we had last week about I can certainly see it going to parity because I can see the ECB cutting another 3 or 4 times, whereas after today's press conference, Powell's basically said you're not getting 4 next year. You'll be lucky to get 2. So that is going to create a bigger interest rate divergence between the dollar and the euro. Now, of course, whether Trump likes that outcome or not is another matter. But it's not down to him. We already know that he's not going to um, basically allow Powell to carry on. So Powell knows that his term as Fed chair is ending in 2026. But I
Mm.
think what was really interesting to me, I think from the press conference and also the statement, was that I think there are beginnings of what we're seeing at the Bank of England starting to manifest itself on the FOMC. And yes, Beth Hammack, who dissented and said that she wanted to keep rates unchanged, is not a voting member next year. I think it's incumbent upon everyone to look at who is going to be a voter next year, because I think there's 4 that rotate in and rotate out.
Yes, you're absolutely right, and I can give you that rotation here because you rather helpfully gave me a heads up that you're going to ask this. So rotating out next year for the in terms of the regional presidents, Daly, Hammack, Barkin, and Bostic will be off of the FOMC, and coming in to replace them will be Jeffrey Schmid, Alberto Mutilum, Susan Collins of the Boston Fed, and Austin Goolsbee of the Chicago Fed. So on balance, I would argue that that tilts marginally more dovish than the FOMC that we've seen this year, particularly with
Goolsbee.
Goolsbee coming in with a vote. He has been very, very dovish, although some perhaps more cynical participants did say that might be due to him auditioning for a role in a potential Harris administration
Well,
had she won the election.
he used to be Obama's economic advisor, didn't he?
He
So he's
did,
always been a
yes.
Democrat. So, you know, I think political leanings do come into it to some extent. So I always
Hmm.
thought that he would probably lean that way.
Absolutely. The other point I just wanted to make while you were talking there,
Mm.
I just called up on Bloomberg here the dot plot from December 2023.
Mm.
So from effectively
A
this
year
time
ago.
last year.
Mm.
And that dot plot had a median expectation that the Fed funds rate would end 2024 between 4.5 and 4.75%. So 25 basis points above where we are
Mm.
now. So it's just worth remembering, and Powell was keen to stress this during the press conference, that the dots are not, a concrete guide as to where policy is going to go.
They're not gospel. They
They
evolve.
are they are not gospel at all. They are
Mm.
effectively policymakers' best guess of
Mm.
where rates are likely to end up. It is a signalling mechanism, but it's also one that evolves over time. So we could easily be sat here after the March FOMC having a conversation saying, oh, well, the Fed are now issuing some more dovish dots than they
Mm.
issued in December, depending on how the economic outlook pans out. And I think that's really the message that we still get from the Fed is one of really laser-like data dependency. They are going to be guided by what the data tells them. If inflation continues to tick higher as it is, or remains relatively stubborn with core CPI above 3%, then they're happy to stand pat on rates. If non-farm payrolls were to flip into negative territory or unemployment pop north of, say, 4.5%, then they'll probably want to ease a little bit more quickly.
Mm.
And I think that's likely, as a result of that, going to lead to much greater market volatility in 2025 because you now have that hawkish risk and not just a dovish risk in terms of the policy outlook.
It's two-sided, basically,
Absolutely.
which is what Powell said. But what I find particularly interesting about all of this is that we've had 100 basis points of rate cuts from the Fed. We're going to get the Bank of England to stay on hold. I think it's
Hmm.
very, very likely that will happen. It'll probably be a complete non-event. Um, and I think the big question is that when central banks start cutting rates, you expect long-term rates to go down. Long-term rates are now higher than when the central bank started cutting, or the Fed and the
Mm.
Bank of England started cutting in August and September, or July and August, or whenever it was. That for me is very interesting because it tells me that essentially central banks want to cut, but the signaling mechanism to the bond market is not working.
Yeah,
And
well,
that has real world effects in the
mm.
economy when it comes to mortgages, loans, and pretty much everything else.
Yeah, absolutely. I actually saw a chart doing the rounds on Twitter before, or X, whatever it's called now.
Mm.
Before we jumped on this call, and I've forgotten who posted it, so forgive me, I can't give them credit. But it was a chart of the 10-year Treasury yield in the United States, and
Mm.
that's risen 80 basis points now from when the Fed delivered that first rate cut back in mid-September. And I think I agree, it is incredibly interesting because it seems that what policymakers are doing in terms of overnight rates is perhaps not being transmitted through to the economy, the
Mm.
real economy, as forcefully as you would expect, or as forcefully as they would desire to see. And of course, as you say, the net result of that is actually that financial conditions are not loosening as quickly as policymakers would like them to. So mortgage rates have actually moved in the opposite direction to that which bank rate has taken, which is a very, very big surprise.
And it's even more, I think it's been more notable here in the UK than it has in the US because I'm just looking at the UK 10-year yield here. Obviously, the market's closed now, closed at 4.6%.
Mm.
Um, and when the Bank of England started cutting back in August, it was below 4.
Yes, absolutely. And we are very, very close, just pulling up a chart of my own. I mean, we ended the day about half a basis point away from the post-budget highs
Mm.
on the 10-year gilt yield as well, which is another sign that markets are clearly remaining concerned about the rather perilous state of affairs on a fiscal basis here in the
Mm.
UK. And of course, we had news this week that Rachel Reeves is going to be hosting another fiscal event on, I believe, the 26th of March. Now, the cynic in me says that she may be looking to host that so early in the year and so soon after the budget, which was, of course, towards the back end of October, in order effectively to ensure that when that fiscal event is delivered, the OBR are doing their forecasts before the economy really gets as bad as it might get once the full impact of those NI changes comes in, which is obviously going to be felt from October onwards.
Well,
April onwards, forgive me.
April onwards. Why hold a fiscal event in March when the tax changes you announce in October haven't even kicked in yet? I mean, that just makes no sense whatsoever, because that sounds to me as if you're doubling down on an error. It's sort of like Dumb and Dumber.
Yes, yes.
Uh, and
I think you're absolutely right. I don't really know
she's not going to be
what
undoing
to add to that. I don't think she can undo it. And
that.
as you said, you won't actually know how much revenue you've raised from the tax changes you've already announced because they haven't
If at
actually come
all.
into effect yet.
If at all.
Um, it does seem quite bizarre. I must admit, when I did see that announcement, I did think it was quite odd, which is why I'm kind of thinking that actually the only objective behind it can be a political one.
Mm. It's an interesting.
Because, of course, Reeves has said, they've made this vow that they're only going to hold one fiscal event a year. So
Mm.
if you get it in early, then the 2026 fiscal event, you could go, oh, things are worse than we expected, etc., etc., etc. We need to come back for more tax hikes, blah, blah, blah.
Well, she actually went on TV and explicitly ruled out that she would not be coming back for more. I thought it was very interesting that Keir Starmer contradicted her on that. He didn't endorse what she said.
Hmm.
So yeah, I mean, I always think it's a dangerous thing when the chancellor holds themselves to a hostage to fortune like that. Rule nothing out, rule nothing in. Then you've
It,
got
it's
nothing to then you've got nothing to apologise for.
Absolutely, it's just stupid, to
It's
be completely
naive.
honest with
It's
you, and
naive.
it is naive because we're dealing with a very, very small amount of fiscal headroom, about 15 or 16 billion pounds, which again, I
That's
appreciate
gone.
that
That's
sounds
gone.
like a lot,
No, it's gone.
but it
It's
indeed.
gone.
Um, and that will go very, very quickly if it hasn't
Mm,
gone already.
mm,
And I think the thing to remember is, that narrow an amount of fiscal headroom, even if the OBR's forecasts are wrong by a couple of basis points, or we get a very minor macroeconomic shock, your headroom's gone. And you're
mm.
going to have to either come back for more tax hikes or go to the market for a significant amount more borrowing, neither of which are particularly palatable outcomes, and neither of which you should be explicitly ruling out when the chances are pretty high that you're going to have to go back on those promises in very, very short order.
Well, I'm just looking at the 10-year yield, and on the closing yield on the UK gilt was 4.35%. We're
Hmm.
now 4.6%. So we're 25 basis points higher. So that headroom's gone on debt
Yeah.
interest. So right, anyway, I think that's that's a subject for next year, and hopefully yields will come down between now uh, and into the new year. But given what we've seen thus far, and we still haven't seen the retail sales numbers yet, and I think they're due out on
Hmm.
Friday.
They are.
But yeah, so I mean, I think it's a little bit of a strange one, that the fact that yields are now higher than but then central banks started to cut rates, and it is a little bit of a worry. And you pointed out the possibility that we could get stagflation next year.
And I hope I'm wrong.
Yeah,
And
so
it's
do
not
I.
often I say that.
No.
Obviously, when you're a strategist and you make a forecast, you want to be right with that forecast. But actually, sat here in the UK, the
Mm,
absolute last thing we want to be dealing with is stagflation, because once
mm,
you're in that hole, it is a very, very difficult hole to be getting out of. And
mm.
you certainly don't want to be going down that path if at all you can help it.
Well, I'm sort of old enough to remember vaguely the 1970s, so I can just
During the
about
war,
during the war, back in the
Uncle
war.
Albert over there.
But I mean, yeah, I mean, I was, sort of middle school then, so I didn't really have that
Sorry, I
many.
thought you were going to say middle-aged.
No, middle school. So I was about in my just gone into double figures to uh, yeah through that particular period, and I have these memories of doing my homework by candlelight on some occasions. So
Oh dear.
Yeah. So that was
But yeah, it's not a
fun
situation
time.
we want to
Fun
be in.
times. No, it's not. No,
That's for sure.
no, no. Certainly not something I want to repeat. So
No.
anyway, so I think we pretty much said all we've needed to say, I think, about central bank decision, the Fed decision, the Bank of England tomorrow again. I think it's likely to be a split decision. Swati
Hmm.
Dhingra is likely to vote for a rate cut. But overall, I think it's really about not spooking the horses and essentially setting us up for 2025 with the possibility of a rate cut in February.
Yeah, absolutely. I think Dinger is almost certain to vote for another 25 basis point cut, so that gives you an 8-1 vote.
Yeah, exactly.
I don't think anyone else is going to be dissenting, certainly after the data that we've had this week. I mean, of course, actually, for those who aren't aware as to the sort of inner workings of the BOE, we're sat here recording this at 9 o'clock on Wednesday evening. They will have actually already voted. They then just spend the Wednesday evening and the Thursday morning preparing all of the statement and the minutes for release at lunchtime on the Thursday. So the vote has actually already taken place, but we can still guess what the vote outcome will be. But I think it's going to be a sort of an 8-1 vote, copy and paste of the November statement, and Bailey will ride off and go and enjoy his holidays and then perhaps come back with a little bit more concrete guidance early in the new year.
Let's hope so. I mean, as I say, they're always making statements and what have you,
Mm,
various, times between meetings. So you can usually get a feel for what the Bank of England might do just based on the data.
mm,
So I think on the data alone, I think we can expect another rate cut. Unfortunately, I don't think we're going to get as many as perhaps we were thinking we were going to get. And certainly today's Fed meeting has pretty much confirmed that when it comes to the US, we're probably only going to get 2 instead of 4. Of course,
mm.
that could change.
Indeed.
Okay, so I think that's pretty much it until after Christmas. So
Well,
thank
it's
you.
not, is it?
Is it not?
Well, no, because we've got some episodes in the pipeline that people can listen to over the festive period that you mentioned earlier on.
Yeah, but I'm talking about this is it until
Indeed, our
Christmas.
last live
Mm.
recording,
But
yes.
after Christmas, there's one going out between Boxing Day and New Year, and then
Hmm.
there's one going out between New Year and when everyone returns to work. So
That's right.
as I say, they're pre-recorded. Hopefully you enjoy them. They're a little bit shorter than this one, but hopefully they will be suitably instructive. Anyway, thanks for joining me again, Michael. It's always a pleasure
Pleasure.
to talk to you, pick your brains about the markets. And I think the next time we speak live will be 2025. So enjoy your Christmas and New Year break, and we'll pick this up in early January. Even though in the pre-recorded one, I've already said all of that. So
I was going to say I'll wish you a very Merry Christmas again,
again,
nonetheless.
yeah,
But
yeah.
people can hear me say that a second time next week. But no, it's a pleasure to join you, and hopefully all our listeners have an
Yeah.
enjoyable Christmas and a happy New Year
And
as
I have to
well.
say, I've enjoyed recording these. These have been good fun, and hopefully, they've been instructive.
Definitely.
All right, cheers, Michael.
Thanks. Bye bye.